Good morning. Three Clowns, Episode 7, April 14th. We've got PPI before the open, and the market's acting like inflation's already solved, which is either the most bullish thing or the dumbest thing we'll see all week. Let's find out which.
My alarm went off this morning and I disagreed with it. So now we're both just ignoring each other.
You and the market have the same problem this morning, Tom. Both just sitting there waiting for someone to tell them what to do. Alex, set us straight.
Yeah, okay. Monday was genuinely strange, and we need to talk about it because today's print might explain why, or it might make it worse. Oil eased on some Iran diplomatic noise, which you'd normally expect to be good for stocks across the board, but here's the thing. Tech just absolutely ripped. Microsoft up 3.6%, NASDAQ leading everything, financials bounced, but energy, the thing that should have rallied on lower oil, totally lagged. Crypto popped, which is the risk is good signal, except defensives got hammered, which is the wait, we're hedging against something signal. And gold? Gold went up despite all that. That's not supposed to happen in a risk-on day. That's a tell. So the question this morning is simple. Does PPI come in cool enough that the market was right to front-run good news yesterday? Or did we just watch everyone pile into the wrong crowded trade before the numbers land? Because if headline or core print's hot, that tape reverses hard. We walk through what moved and why Monday felt backwards, then dig into what PPI says about whether the Fed's actually done, then the Nerd Corner figures out what the rate AI trade looks like after yesterday's test. Tape is up.
Gold up on a risk-on day just means someone's buying insurance while selling you optimism. And energy lagging with oil easing, that's the market saying demand's the problem, not supply.
That's exactly it, Tom. If PPI comes in cool because demand's rolling over, that's not the all clear. That's just the economy catching a cold while the market thinks it's a spa day. Not the same thing.
Yeah, and if that cold turns into pneumonia, we won't see it until the fever spikes. Tape first. The price action might tell us more than the headline number. Let's go. All right, so Monday we got a proper risk-on day. And I mean proper, not the fake ones where tech runs and everything else treads water. SPY up 98 basis points, QQQ up 103, but here's what matters. Small caps beat them both. IWM at 144, that's breadth. Financials crushed it, XLF up 175. And the reason is pretty clear. Late session we get word that private credit exposure isn't systemic, credit fears ease, and suddenly the entire non-megacap world starts breathing again. Asia was bid overnight on Iran deal hopes, which set up the global risk-on tone coming into the U.S. Open.
IWM outperforming QQQ is not what you'd expect if rate fears were the dominant story. Small caps are more rate-sensitive than megacaps. That move says the market decided credit risk is lower, not that it decided rates are going anywhere.
Exactly. And then you get the AI bid recharged on top. MSFT up 364, XLK broadly up 210. Apple couldn't keep up, though. Down 49 basis points while Microsoft was ripping. There's a divergence inside megacap that's worth unpacking, but Tom's going to get to that. Energy is the weirdest story. Crude up via USO almost 3% on Iran deal noise, but XLE, the sector itself, basically flat at 30 basis points. The market's treating the geopolitical bid as transient. And then you've got the risk confirmation signals. Bitcoin up 2.9, coin at 4%. Defensives getting shellacked, utilities down 121, staples down a full percent. Classic rotation. Oh, and Tesla up 98 basis points. Tom's gravity thesis is still patient.
So crude's up 3 and the producers shrug. That's the market saying, we'll take the cash flow today, but we're not underwriting it. Because if oil actually stays here, those stocks don't go up 30 basis points.
Right. If this were real, energy stocks would be repricing their decade. But they're not, which tells you the street thinks Iran talk gets resolved in a week and we're back to 85. Ray, does the breadth picture back up that read, or is something underneath flagging a problem?
I spent yesterday afternoon looking at the Russell and thinking, if small caps are outperforming the Qs, the market is betting the consumer isn't actually broken. But gold being up alongside AI and crypto is the real contradiction. Someone is still hedging a macro tail risk while everyone else is partying. That's not a clean risk on tape, Alex. That's 2 trades running at once.
Gold up on a risk-on day just means someone's buying insurance while selling you optimism.
Yeah, the market's literally pricing both outcomes at once. Risk on in tech and small caps, hedge trade in gold, both running simultaneously. That's exactly the setup where PPI becomes the arbiter. If wholesale inflation's rolling over, gold unwinds and the risk on gets confirmed. If it's sticky, the hedge wins and we've got a much messier picture underneath the SPY strength. Which trade survives the morning? That's what Footnotes is about to figure out.
Yesterday I was watching this old house renovation show, and they found a leak behind the drywall that had been there for years. That's what PPI feels like to me this morning. Everyone's looking at the fresh coat of paint on the S&P, but PPI tells you if the structure is actually dry. The real arbiter here is core PPI, because goods have basically normalized. Supply chains are moving again, but services are where the heat is trapped. If that core number prints hot, it's not something the Fed can look through by blaming a gas station. It means the basement fire I mentioned last episode is still getting oxygen from the service sector, and that keeps the Fed's hands tied, regardless of what the tech bulls want.
And the gold move backs that up nearly 0.75% pre-market while everything else is risk on. That's not a metal that trusts the peace. Ray, what does that tell you about the oil-Iran signal?
Gold is literally telling the AI rally it doesn't trust the peace. Even if oil eases on these Iran-US talks, the shipping costs and war risk insurance are sticky. Those don't normalize for weeks, even after a diplomatic signal, which keeps that PPI floor higher than the market wants to admit. Then there's Blue Owl. They pulled in $400 million for private credit right after the watchdog said the sector isn't systemic. Is it actually de-risked? Or are we just seeing a relief squeeze because the regulator didn't drop the hammer? And Pakistan's reserves getting squeezed, that's your EM canary. When those sovereigns start hunting for dollars to stay afloat, it drives up USD demand and acts like a secret handbrake for commodities and risk assets. The 10-year closed at 4.3 yesterday. That's the number to watch.
So when the watchdog says private credit isn't systemic, the 10-year flatlines at 430 instead of rallying into that relief. Is the bond market just not convinced, or is it pricing something else entirely?
Alex, that 430 sitting there like a stone is actually the most honest thing in the market right now. If the bond market really bought the not systemic headline as a total de-risking event, we'd see that yield move. But instead, it's just paralyzed. Bond traders have been burned by press releases before, so they're in show-me mode until the PPI data hits. They aren't looking for reassurance from a watchdog. They're looking for the math on inflation to see if the Fed actually has room to breathe. I was looking at Fred charts on yield gaps during the 2023 bank wobbles, and it's the same pattern. Total silence before the data provides the real direction. Tom, do you think the equity side is being way more optimistic than the math allows for?
Yeah, probably. The 10-year at 430 isn't exactly screaming, things are about to break. It's just saying it in a less enthusiastic accent. Equities are either early or they've decided the math will catch up out of embarrassment.
The ultimate fake it till you make it for the S&P. But with gold running insurance and the 10-year in show-me mode, the math isn't just embarrassed, it's waiting for a verdict. Since PPI is the arbiter of whether the Fed can even move, Tom, take us into the nerd corner and show us how that rate pressure actually squares with the AI growth projections.
Yeah, so, episode 6, we said the test is live. Monday was round 1. NVDA holds, AI bid doesn't crack. Everyone nods and moves on. Today's actually the harder one because PPI feeds straight into the part the Fed can't ignore. Hot PPI means producer costs aren't rolling over, which bleeds into core, which keeps the Fed parked, which pushes the 10-year higher. We're sitting at 430 now. Episode 6 math was pretty clean. 5 basis points is about 6.5% off meta at these multiples. 20 basis points is roughly 26%. The level where it stops being theoretical is 445. We're 15 basis points away. And that's where the split matters. MSFT versus AAPL isn't just style, it's sensitivity. Enterprise AI spend is budgeted, multi-year, doesn't care if gas is $3 or $5. Consumer hardware absolutely does. So MSFT can sit there and pretend rates are a rumor. AAPL actually has to live in the economy those rates create. If PPI comes in line, the market just keeps choosing the story. AI productivity outruns everything. Multiples hold, nothing breaks. If it's hot, you're not arguing narrative anymore, you're paying for duration. And 445 is still the number where that starts showing up in a way people can't ignore.
Tom, that 445 on the 10-year is the cliff. And I kept watching Bitcoin rally right alongside the NASDAQ yesterday thinking, is it just high beta or is it the canary? If that belief system cracks, speculative liquidity in crypto usually drains out first because it's the purest vibes measure of financial conditions we have. Bitcoin's up over 5% in the last 24 hours, sitting above 74,000. That doesn't scream, people are pricing a rate shock.
Tom, you nailed it Monday. NVDA closed green when nobody thought it would. But today it's basically flat pre-market even with a bid under equities. If PPI prints hot and the 10-year starts creeping toward 445, does NVDA actually lead the sell-off? Or does it lag because the AI as strategic infrastructure narrative keeps it bid a little longer than everything else?
It probably lags, because there's an actual bid under it. Export controls, sovereign positioning, hyperscalers already committed. That money doesn't flinch on the first rate move. But if the 10-year keeps climbing and the discount rate resets hard enough, the strategic label just becomes a more expensive way to say 35 times. BTC goes first. No earnings, no contracts, just mood. So when liquidity tightens, it drains fastest and tells you what the rest is about to admit. The test continues in the calls.
All right, scoreboard. Tom finally broke the seal yesterday. NVDA closed green, first win in show history. The reverse signal has a crack in it. Ray whiffed on the 440 10-year and I completely botched my QQQ call. It closed at 617. Ray still has his episode 5 442 call alive through Friday, needs 12 more basis points by then. Otherwise, we're sitting at Tom 1, me 0, Ray 0, which tracks.
Right, that's one. Try not to get used to it. If PPI prints hot, NQ gives back at least half its pre-market gains by today's close.
0 for 4. Honestly, if I call a recession today, you should probably go buy a second home to celebrate the coming boom. Tom's PPI setup is smart, but I'm holding my existing call. Episode 5, 10-year at 442 by Friday. That's still live. It needs 12 basis points from here, and if PPI prints firm this morning, that becomes a very real conversation by Thursday.
Ray, smart to sit tight. 442 is the right number if we get any real print today. Here's where I'm going. I'm calling QQQ closes the week above 625. Tom's probably right that NASDAQ dips on a hot PPI, but I think the rotation just buys the dip. We don't get the capitulation, the AI bid holds through end of week. My call. QQQ above 625 by Friday close.
QQQ above 625. So we just decided inflation is a personality trait now, not a constraint. If PPI's hot, the market remembers math for about 45 minutes. Then we'll see.
Look, if the market forgets math for 45 minutes, I'm just glad we're here for it. PPI's in before the bell, so we'll find out real quick if inflation's still got that personality. Tom, Ray, thanks. That's the show.